Is at the pump. I go grocery shopping. I know what beef and poultry and eggs and dairy and a lot else costs. So the inflation's real. But going back to what I said at the beginning of our discussion, with the economy going into recession, looks like a global recession. And then from that, you get business failures, unemployment, et cetera, unemployment going up, and then higher interest rates means higher mortgage rates, fewer housing starts, et cetera. The Fed cannot do anything about the supply side. The inflation is coming from the supply side. It can come from supply or demand. The supply side means energy, food, transportation costs, and a lot else besides, and then also taking into account the breakdown of the supply chain, which we mentioned earlier. Demand-driven inflation comes from the consumer. It comes from the psychology. Do people feel the prices are going up? And if they do they start to change their behavior and pull demand forward? That's why they call it demand pull inflation, and say, I was thinking about buying a refrigerator. I better go buy it today because the price is going to go up if I wait another month, et cetera. Both of those can be sources of inflation. They can feed on each other. Right now, the inflation is all coming from the supply side. We have not tipped over into a demand demand-driven inflation, but we're getting dangerously close. So what can the Fed do about the supply side? Well, they don't drill for oil. They don't drive trucks. They can't farm for crops or run a textile mill. The Fed can't do anything about the supply chain or the supply of goods and services. The one thing they can do is raise interest rates enough to destroy demand, not just tamper it, but really destroy it to the point where, hey, maybe I don't like paying a lot for gas, but if I get fired from a job, I might not be buying gas at all, or just cutting down on driving, or, eating cheap substitutes for, better quality food, et cetera, or some people starving. I mean, I wouldn't rule out any of those things. So can the Fed control inflation at the end of the day? The answer is yes, but at an extremely high cost. It's not a question of pivoting to interest rate cuts next January. That's the narrative. It's just not true. If interest rates go down, it'll be because we're in a very severe recession. And of course, the Fed will be the last to know. So the Fed can temper inflation, but at a very high cost, the cost of a very severe recession. So at that point, the good news is prices are down or flat. The bad news is you just lost your job. And obviously, and why is that good for stocks? I guess that's my question. So the answer is it's not. So, but if you live in a world where we have very strong inflation today, but we could be facing disinflation, almost certainly, and possible deflation, how do you structure that portfolio? Because if I could guarantee inflation for a couple of years, that's easy. Buy gold, real estate, fine arts, silver, energy, agricultural, hard assets. If I could guarantee deflation, that's also easy. You want cash, government bonds, and a few other assets that are going to perform well in a deflationary environment.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information, and it helps us spread that message. Sharing is caring. And now, let's continue.
But what if I said, and I am saying, we have inflation now, but we could flip to deflation, but it's hard to know exactly when. How do you position for that? And the answer is diversification. You have a slice of gold, I recommend 10%, a slice of cash, which not only protects you in deflation, but gives you liquidity, reduces the volatility, and gives you optionality. So when we get more clarity, you can actually go, maybe shopping among the ruins of the stock market. This is a place for stocks, but I would lean towards energy and the agricultural sector and other natural resources, and alternative investments, and certainly real estate and government bonds, which do very well in a dropping interest rate environment, which we're already in. The short-term rates are still going up because of the Fed, but intermediate to long-term rates are coming down. And if you have 10-year Treasury notes, you could get very significant capital gains if the yield to maturity on the 10-year note drops from, let's say, 3% to 1.8%, which is where it was not that long ago. So getting back, and I know the question, Brian, was about gold miners, but my point is, have some, and they will perform well, but only a slice. In the slice, as far as gold mining is concerned, are there supply chain issues? Yes. but that should actually help the price of gold. In other words, if you think of supply and demand, demand is what it is. It has its own drivers, including real interest rates, fear factor and inflation and other factors. But if the supply is constrained by the supply chain, then that's actually bullish for the price of gold. As far as miners are concerned, there's no such thing as a generic miner. I don't think of miners plural. You have to take it company by company, and you have to ask yourself, look, geology is what it is. Engineering is what it is. Cost of capital is what it is. Those things tend not to vary that much. The biggest variable, the thing that will separate a successful miner from one not so successful, is the management. You need to look at the CEO, the chief geologist, the CFO, look at their resumes, ask yourself, have they done this before? Is this their first, are they beyond the exploratory stage? Are they into the production stage? Are they a possible takeover candidate for Barrick or Newmont or IAMGOLD or one of the big guys? I mean, they don't actually do that much exploration. What they do is they just buy successful early stage or mid stage production companies. And so that being the case, there are a couple of ways to make money in gold mining. One is if the price of gold goes up, well, that'll take the stock up. Two, if they have more gold than they thought, they had a certain estimate. It turns out they have much bigger veins, and that's good. But the third way to make money, a takeover premium. Somebody comes along and buys them and pays more than the market value for the shares to do an acquisition. So there's some very attractive opportunities, but you just have to be selective and focus on management, because that usually is the determinative factor between a success and failure.